Hello, I'm Chris Pedersen and this is Stock Watch on Wednesday, the 21st of February, 2024. All advice is general advice and might not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be directed to stockwatch@fnn.com.au. Some market observations from me. Well, I've been watching earnings seasons very closely, and what I see is that there's not that many stellar results. Of course, there's some, but most are in line or a little bit on the weak side. This is a little bit of a concern because analysts have more EPS downgrades than upgrades right now. We're about halfway through. This week is huge in terms of the number of companies reporting. What I also see is the big market cap stocks, the ASX 100 companies, are the ones that tend to be stagnating. None of them have had a really big upside surprise. This is disappointing, but what it really means is that the ASX 200 index is going to struggle to get to 8,000 this year. We really have to have a bull market, and if these companies aren't having great growth, well, that will keep the ASX index down. However, as a stock picker, and you pick companies that do have good earnings surprises on the upside, you will do well. It's just the index itself is going to be struggling a little bit. Goldman Sachs predicts the S&P 500 is going to end the year at 5,200. Current level for the S&P 500 is 5,005. So that's not all that much of a rise from here. So Goldman is slightly bullish. The Magnificent Seven, I've gone through that previously. Those 7 companies that are huge in terms of market cap, they happen to generate more profits than all listed companies in all G20 countries except for US, China, Japan. Think of it. These 7 companies are more profitable than the entire stock market of all G20 companies excluding US, China, Japan. That means Germany, UK, etc. It's incredible. Here's a chart that I thought you'd be interested in. This is Australian barley exports to China. Well, surprise, surprise. So China's willing to take exports again? Well, look at the line. What is kind of disappointing is that Australian farmers were exporting around the world, but now suddenly they're shifting their exports to China. From a business risk perspective, if I had developed customers elsewhere, I would continue selling there, and I would only add China for incremental growth. This chart's interesting. This is of the ASX 100 sector weightings. Take a look and see which sectors account for how much of the market. This chart shows where we buy fast food. On the left, you see McDonald's. The dark bar happens to be young people, well, 34 and under, and the lighter brown is the entire population. What is interesting digging into this is that young people aren't necessarily bigger shoppers at McDonald's than the population as a whole. And this kind of applies to all the other fast food chains. And it even has Red Rooster in there. This is where the youth live in Australia. There'll be surprises, like Bankstown is one area. It's worth taking a look at. Household wealth in Australia. I included this because the black line at the bottom is a ratio of income to debt. What you see is that Australian households are not getting buried by having too much debt. That is significant. We hear that all the time in the press. Well, the reality is we can service our debt. It is the other factors that are important. This chart shows you real GDP and nominal GDP in Australia by different categories. It's worth seeing where we're getting our GDP growth from. Now, real GDP is nominal GDP, which is the actual, with the inflation rate subtracted out. When you look at how the share market is performing, the important number really is nominal GDP, because a company, when they're selling cars and the price is up 5% and inflation is 5%, they don't advertise that the price is zero increase when you strip out inflation. No, it's up 5%. Well, that's the nominal increase. Now, this is a little thing that I do is I actually monitor stock watch companies and my recommendations for full weight, half weight, shorts, etc., and how they perform. I started doing stock watch again on 19th of July, and this is through last Friday, the 16th of July, that on an annualized basis, if you follow all the recommendations in stock watch, you're going to be up 43%. This is annualized. There's two companies I wanted to share with you this week. The first one is Suncorp Group. The reason I'm showing it now and not earlier is I've liked Suncorp for a long time. However, with the banking division being disposed of, I needed to wait to see would the ACCC actually agree to get rid of the bank. That Suncorp without the bank is probably going to be performing better than with the bank. And that's because banks are slow growth. But insurance companies, they've been increasing premiums. They've been a stellar sector. Take a look at this chart. It's a 5-year chart. Suncorp has done amazingly well. And disposing of the bank is only good for shareholders. Yes, the company shrinks some, but the remaining business is more profitable. Today, Suncorp is trading at $15.11. And take a look at the right-hand corner. It is just continuing to go up. The concern I have is, has it gone up too far to get in at this stage? Let's take a look at the numbers. With a 12-month price target that I have of 17, that this company still has $2 of upside potential over the next 12 months. I like Suncorp, but let's drill deeper. The revenue growth rate from 2023 to 2026 is now estimated at 10% per annum. Well, that's pretty good for a large Australian company. Earnings per share growth, same period, is 8% per annum. That's pretty good. And the dividend growth, same period, is 12% per annum. So these are all decent growth rates. They aren't extraordinary, but they're solid. The PE on the 2025 earnings estimate of $1.09 is only 14 times. That's attractive. The dividend yield on the 2025 dividend estimate of 82 cents is 5.4%. This is very, very good. The payout ratio now is 60%, but it's going to be jumping up to 70% a couple of years from now. It is a general and life insurer. It has brands which are Amy, which are very well known, Vero, GIO, AA Insurance, RACQ, and Promina, and a few others. Now that the bank is gone, I like Suncorp. I would buy it at half weight simply because it's already had a big run. But as we know, you buy long term, a good company will continue performing. Goodman Group is the second company. The code on the ASX is GMG. It's trading at $28.84. It's a 5-year chart. Just take a look at it. It is an amazing performer. It just continues to go up. Sure, it dropped during COVID. All companies dropped. When the tide goes out, all boats drop. However, good companies recover quickly and they don't drop as far. Goodman really is performing, and the chart shows it and the fundamentals show it. Right now, a snapshot, it's got a market cap of around $54 billion, so this is massive. I have a 12-month price target of $30.50. Some brokers are up at 31. Other brokers are down at the mid-29s, like 29.50, 29.75. I have a revenue growth rate from 2023 to 2026 of 13% per annum. This is rents. And earnings per share growth is 11% per annum. Now, dividend growth is subdued. It's only 4%. It has been 30 cents, but it's going to be starting to go back up. The PE on 2025 earnings estimate of $1.20 is a little bit rich at 24 times. However, a company that continues to perform, that is not a high PE. The yield on the 2025 dividend of 32 cents, well, this is a low yield. It's only 1.1%. But you're not necessarily buying it for the yield. You're buying it for the capital growth. The payout ratio is only 25.5%. This is an average over this year and the next 2 years going forward. Now, Goodman Group is a industrial real estate investment trust. It is one of the best performers in Australia. I rate it a buy, 100%. You might have to hold it for a while, but this company, as you see, continues to perform. Warren Buffett has a term that it is good to buy really excellent, wonderful companies, and paying fair price is perfectly fine. You don't have to buy a really good company cheap. Often, if you buy a company really cheap, there's a reason it's cheap. It's not performing. However, really good companies, if you pay fair price, you will make money. As always, if you want to learn more, send an email request to stockwatch@fnn.com.au, and I will endeavor to get back to you. Thank you for your time, and I hope you have a profitable week.